Thinking about selling or expanding into Canada? Well, you're almost always going to need a Canadian CPA, but not to worry because that's what today's video is about. Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today's video is about why having a CPA in your corner is a must when expanding into Canada. And as always, if you're a US company trying to survive the Canadian tax jungle, click on that subscribe button and hit that notification bell. Or for more personalized service, contact me directly through the MacTax.com. So why do you need a Canadian CPA? Well, just like in the USA, it's not just knowing the tax law, it's being able to navigate the tax system. The first problem you're going to run into is that after you register your business with CRA, the only person CRA will speak with in your company is the person whose name was on the registration. And that person had to be an officer and director. And chances are your officer and director is going to be way too busy to sit on the phone and wait for CRA and talk to them. The trick is, as soon as you're registered with CRA, send in the paperwork to authorize a CPA to talk to CRA on your behalf, preferably me. Now, FYI, CRA has a very user-friendly website where you can communicate with CRA through your online account. Problem is, someone in your organization must have a Canadian tax ID number, what we call a social insurance number, what you call a social security number. Somebody in your organization must have a Canadian tax ID number in order to access your account on the CRA website. And chances are you do not have someone in your organization that has a Canadian social insurance number. Now, as an aside, there's loads of tax information on your company that you can access through your account on the CRA website, including, and I apologize for reading off a list, all your previous CRA correspondence, previously filed returns, assessments, expected returns by due date, and this would include your corporate tax return, your sales tax return, and your payroll. Installment information and your statements of account are all available on the CRA website, and that's just a sample. There's a lot more there. And in fact, if CRA requests information from you, you can scan it PDF and upload it to your account on their website. Don't even have to mail it in. And that's a good way of doing things because as soon as you upload it, you get a confirmation number and CRA can never say you never sent it in. But again, the problem is, in order to have access to your account on the CRA website, someone in your organization has to have a social insurance number. So what are you going to need to do? You're going to need to have a Canadian CPA in your corner. In fact, I'm dealing with this issue this week. I have a client that has a real quagmire with our national sales tax. The problem is the only person CRA had on file to talk to had left the company. We had to go through the whole process of getting the corporate documents to prove the new authorized person was in fact an officer or director of the company. We had to mail that all in. Once it was all in and on their website, they appointed me as their representative. And here's the funny part. CRA was so eager to get this problem solved. As soon as they saw my name on there, they called me right away and we had the thing resolved in a matter of minutes. It just took hours to get the right authorized person on there. In fact, it took weeks to get the authorized person on there. That is why I am telling you, as soon as you register your business with CRA, appoint a Canadian CPA to act on your behalf, or you're going to be dealing with hours and hours of headaches. Now, here's another good reason why you're going to want me to represent you up here. Unlike the United States, where the IRS computers only read the first two pages, i.e. the jacket of your corporate tax return, in Canada, the CRA computers can read and analyze every single number on your income tax return, including the jacket and including all the backup schedules. And what's more, your Canadian income statement and balance sheet are entered onto your Canadian corporate tax return with unique identifier codes. So not only can the CRA computers analyze your tax return, they can analyze your financial statements. And not only can the CRA computers analyze your tax return, they often do. Here are two requests for information right now from the CRA. I got two separate clients. And if you'll notice, I don't know if that's right here, it's not signed. The computer does the analysis and sends out the request for information letter, which again, you're supposed to scan PDF and upload onto your account. But the computer does this without ever telling a human. A human does not even know about this letter until you upload it onto their website. And as an aside, if you look at some of my previous videos, you'll find the best way to avoid these letters is to have crisp and clean bookkeeping and all your company records. There is nothing that beats the CRA algorithm better than crisp and clean records. And so now we've talked about navigating the tax system. Now I'm going to talk about 5 key differences between the Internal Revenue Code and the Canadian Income Tax Act. That not knowing these differences can lead you to problems, and again, why you need a Canadian CPA in your corner. And again, I apologize for reading off a list. Number 1, we do not have consolidated returns up here. So if you have one subsidiary with losses and another subsidiary with income, The subsidiary with income pays tax, and the subsidiary with losses has a loss carry forward. I know you guys are so used to filing consolidate, and this sounds ridiculous because economically, if loss co equals profit co, there is no profit, but that's how we do it up here. Our provincial tax nexus is much different than your state tax nexus. And if you have nexus in a province, you're probably going to have to collect the sales tax there and probably have to file there. So again, you'll need a Canadian CPA to help you through the provincial nexus issues. If you have an asset up here in Canada where the depreciation for a year is $1,000, I actually have the option on my tax return to claim anything between $0 and $1,000 for that asset in a year. This has great implications for the GILTI tax because, as you know, with GILTI, if you're taking the 962 election, you're going to get the best result if your taxable income for Canadian tax purposes is the same number as the taxable income for GILTI tax purposes. So this is something we use to try to get those two numbers equal so you don't end up paying the GILTI tax in the US. Here's another one that's going to surprise you a little. Loans from a Canadian subsidiary to a US parent, if they're outstanding for more than a year, will be deemed as dividends and subject to withholding tax. If your sub lends your parent $1 million and it's outstanding over a year, you're going to get whacked with $50,000 of withholding tax. In the Internal Revenue Code, loans from subsidiaries to parents are fine as long as they're done at a fair market value interest rate with fair market value terms. Not so in Canada. All loans outstanding more than a year, and by the way, a year is only a guideline, okay? It doesn't have to be a year. Any loans from a Canadian subsidiary to a U.S. parent will be recharacterized as a dividend and subject to 5% withholding tax. Once this assessment is made, you cannot get out of the withholding tax by paying back the loan. Here's another one, and this one's pretty much similar as the U.S. Even if you are exempt from tax under the treaty, you still may be required to collect and remit one, our national sales tax, and two, maintain a payroll. And as an aside, you may be required to maintain that payroll even if your U.S. employees working up here in Canada are exempt from Canadian tax. You would still have to file the payroll. It would be nil, but you're still required to file it. Obviously, not knowing this stuff can lead to potential double tax, interest, and penalties, and that's on top of a whole lot of hassles. Corporate tax is just one of the differences you've got to be concerned about up here. There's also our national sales tax, and this one is really difficult to articulate what the issue is. We have a national sales tax that everyone is subjected to right across Canada in all 10 provinces. The problem is each province has their own sales tax system. Some of these provinces piggyback on the federal sales tax. Some of them have their own sales tax systems, and some of them have no sales tax at all. And then this gets compounded again by the nexus issue and as to whether or not you're supposed to be collecting tax in that province and whether or not you're supposed to collect just the national sales tax or the provincial tax as well. It gets really complicated really quickly once you're selling into multiple provinces. Again, why you need a CPA in your corner. Again, why you need a Canadian CPA in your corner once you start selling into Canada. Okay, so that's sales tax. So now I want to talk about a specific problem that's really a problem of tax law and the fact that CRA can analyze your tax return really easily. And that is the issue of employee versus independent contractor. We have the same issues up here as you do in the States when it comes to employees and independent contractors. If CRA comes in and determines that one of your independent contractors should have been an employee, you're going to have to late file all the payroll withholdings with interest and penalties, just like in the US. But the reason it's a little more of an issue up here is because the CRA can see the line on your tax return that says independent contractor and send you out a letter requesting information on that without a human ever knowing. The reason it's more of an issue up here is the CRA computers can read your financial statements. They can see that line item that says independent contractors, send you one of these letters requesting information on the independent contractor. And by the way, they will be very specific about the information that they want. Again, you would have to scan it and upload it and send it into CRA. The advice I give all my clients is make sure you know the information CRA wants to see ahead of time in case they ask for information on your independent contractors. But it happens a lot up here. I caution you on that. So employees versus subcontractors is a specific example of how our tax law and tax system sort of come together to cause you problems. But now I want to talk about the tax treaty a little bit. In order to receive the benefits under the Canada-US tax treaty, you're going to have to do the same thing up here as you do in the States. And that's file a corporate tax return and claim treaty protection. But there's some other issues you've got to be aware of as well. Interest paid from a Canadian subsidiary to a U.S. parent is not subject to withholding tax. If you don't file the correct forms, in this case the NR4 forms, CRA is in the position to recharacterize that interest payment as something else, like a dividend or a management fee or something that makes it subject to withholding. So you want to make sure you got all of your bureaucracy in place whenever you're using the treaty. Okay, so far we've talked about navigating 1, the Canadian tax system, 2, our national sales tax, 3, differences between U.S. corporate tax and Canadian corporate tax, and 4, claiming treaty benefits. Now there's something else I want to talk about, and that's structuring. That is, before you ever expand into Canada, you really need to work with a Canadian CPA about how that expansion is going to look. Are you going to do it as a branch? Are you going to do it as a subsidiary? If it's a subsidiary, are you going to have one subsidiary or more than one subsidiary? If you incorporate up here, are you going to do it with a C Corp, i.e. a per se corporation, or are you going to do it through a Nova Scotia or Alberta ULC? The difference between a C Corp and a ULC, down the road, you can check the box on a ULC and make it a disregarded entity if it's to your benefit to do so, but you can't do that on a C Corp. And you know what? The tax consequences are the same up here whether you use a C Corp or a ULC. That's something for you to keep in mind. The main purpose of a structuring is to repatriate as much of your Canadian profits as you possibly can without paying tax up here or withholding tax. Usually when you're expanding into Canada, the US parent is providing a lot of services to the Canadian sub. You can bill for these services. When the Canadian company pays for these services are not subject to withholding tax and they are deductible in Canada. However, under the Canadian Income Tax Act, Section 69, the amount the Canadian subsidiary pays to the US parent for these services must be reasonable in the circumstances. If they're reasonable, again, the Canadian company can deduct them and they're not subject to withholding tax. If they are unreasonable, CRA could recharacterize them as management fees and make them subject to a 25% withholding with no relief under the treaty. So again, this is a great strategy for getting your profits out of Canada and back to the US, but make sure you're compliant with all the rules we have surrounding this. Okay, so navigating the Canadian tax system, differences in the tax law, our sales tax, structuring, all of these things you're going to need the support of a Canadian CPA. So if you're expanding into Canada, don't do it blind. Partner with someone like me, get going on the right foot. So if you found this helpful, don't forget to like and subscribe for more helpful tips on the Canadian tax system. And as always, if any of this hit home in a way that you need immediate attention, contact me right away through the MacTax.com. That's what I'm here for. Until next time, stay sharp, stay compliant, stay out of tax trouble, and I'll see you on the next video. Take care.